Does the VA funding fee actually cost you anything if you are disabled? For a lot of San Antonio veterans, the answer is zero, and most people never find that out. I am Christopher Beal with Veteran Real Estate San Antonio, and today we are breaking down the VA loan funding fee, top to bottom, for 2026. So what is it, and why does it even exist? The funding fee is a one-time charge the Department of Veterans Affairs adds to most VA purchase loans. Here's the logic. Your VA loan lets you buy with zero down and no monthly mortgage insurance. Somebody has to keep that program funded for the next generation of veterans. That is the funding fee. It is not a bank fee, it is not a commission, and it is not a hidden cost your agent slipped in. It goes straight back to the VA to keep the whole program running. And think about what you are getting in return. On almost any other loan, putting nothing down means paying monthly mortgage insurance for years. The VA loan skips all of that. So when you compare it fairly, this one-time fee usually costs you far less than the insurance you would pay on a conventional loan. Stick with me, because in a minute, I will show you who pays nothing at all. Okay, next question, the one everybody actually wants answered. How much is the VA funding fee here in San Antonio in 2026? If this is your first time using your VA benefit and you are putting nothing down, which is how most veterans buy, the fee is 2.15% of the loan amount. If you have used your benefit before, that jumps to 3.3% on a zero down loan. Now here is a lever a lot of people miss. The fee drops if you put money down. Put down 5% and it falls to 1.5%. Put down 10% and it drops again to 1.25%. First use or repeat use, same number. Let me make that real with San Antonio price points. Say you are a first-time user buying at $300,000 with zero down. Your funding fee comes to $6,450. Move up to a $350,000 home and it is $7,525. If you are a repeat user at that same price, you are looking closer to $11,550, which is exactly why the exemption we are about to cover matters so much. One more. If you are just refinancing an existing VA loan with a streamline, the fee is only 0.5%. So the number really depends on three things. First use or repeat, how much you put down, and whether you are buying or refinancing. Now the chapter that saves people the most money. Who is exempt from the VA funding fee entirely? If you receive VA disability compensation at a rating of 10% or higher, you pay zero, nothing. That single rule wipes out the entire fee we just calculated. Purple Heart recipients are exempt too, and so are many surviving spouses receiving dependency compensation. On a typical San Antonio purchase, that exemption is worth somewhere between $4,000 and $11,000 straight off your closing costs. And here's the part that honestly gets missed all the time. Say you close on your home, pay the funding fee, and then your disability claim gets approved a few months later with an effective date before your closing. You may be owed that entire fee back as a refund. I have seen veterans leave thousands of dollars on the table simply because nobody told them to go back and ask. So if your rating is still pending when you buy near Lackland, Randolph, or Fort Sam Houston, flag it early and keep every piece of your paperwork. The exemption is tied to your VA status, not your lender, so it applies no matter who you close your loan with. Your certificate of eligibility usually shows whether you are exempt, and a good loan officer will confirm it before you ever reach the closing table. So, let us say you are not exempt. Should you finance the funding fee or pay it in cash at closing? For most veterans doing a zero-down purchase, the standard move is to roll the fee right into the loan. You do not bring it to closing at all. On a typical San Antonio loan, financing the fee adds somewhere around $30 to $50 to your monthly payment. That is it. For a lot of buyers, keeping that cash in the bank for movers, furniture, or a PCS transition is worth far more than the small bump in the payment. On the other hand, if you have the funds and you plan to stay in the home a long time, paying the fee in cash keeps your loan balance lower and saves you a little interest over the years. Neither answer is wrong. It really comes down to two things: your cash on hand and how long you plan to hold the property. My honest take, most people overthink this one. Run both numbers with your lender, look at the actual monthly difference in dollars, and pick the one that fits your life right now, not a spreadsheet 10 years down the road. Last question, and this is the negotiation lever hardly anyone uses. Can the seller pay your VA funding fee? Yes, they can. Under VA rules, a seller can cover certain costs for you as what is called a seller concession, and that concession can go up to 4% of the home value. The funding fee is allowed to come right out of that 4%. So in the right market, you can negotiate a deal where the seller effectively picks up your funding fee and you keep that money in your pocket. Here is the nuance. That 4% concession bucket is separate from the ordinary, customary closing costs the seller might already be paying. It is meant for the bigger items like your funding fee, prepaid taxes, or paying down debt to help you qualify. In a balanced or buyer-friendly stretch of the Bezier County market, that is real leverage, and it is exactly the kind of thing I write into offers for my clients. So let us recap. The funding fee is 2.15% first use, 3.3% after that, and less if you put money down. If you have a 10% disability rating or a Purple Heart, you pay nothing. You can finance it or you can negotiate for the seller to cover it. I am Christopher Beal with Veteran Real Estate San Antonio. If this helped and you are buying or selling anywhere around San Antonio, reach out and let us put it to work on your deal.